we need to have these separate companies become affiliated employers.
Is it legal to take a loan against our own unleveraged property as a means of asset protection?
IRAs and 401ks can own actual precious metals.
And she's like, I want to take the money from my rental property cash flow and put it in a 401k. Is it legal/possible? That's what's called equity stripping.
That could cause a lot of havoc for those of you with inherited IRA accounts, okay?
Welcome, everybody, to this week's episode of the Directed IRA podcast with Mark Kohler and Mat Sorensen, your wannabe, self-appointed, directed IRA 401k experts in America. Yes, we're going to say it, damn it. We're going to just call it out and say, you want answers? You got questions? We got answers. Gosh, that was so good until that last little stumble. I thought I had it.
The wannabe part. Wannabe? Psh, we're doing this every day. We're the goats, you know, we're the goats. No, just this, we love this stuff. We self-direct our own retirement accounts. We've been advising clients for years, decades, as both tax attorneys, and we have a trust company where we've got over $1 billion in assets under administration, 10,000 plus clients doing this stuff. So we love it. We're doing it every day, and we've got your questions. All right, this is from Sean Espinoza from California. Sean asks, I'm 61 years old and retired. I currently have a self-directed IRA that owns a Tennessee single-family rental worth about $250K. Is it possible to get the property out of the IRA? Could I take a full distribution by requesting the IRA custodian deed 100% of the property to me in my personal name and pay tax on the distribution at fair market value of the property? If yes, could I pay it in 25% increments? He's asking questions here. We're going to get, it's longer here. I'm going to truncate this, but let me hit this first question here, Sean. If you have a self-directed IRA that owns real estate and you want to get it out of the IRA for whatever reason, maybe you want to start using it personally, maybe you want it to be a personal rental for whatever reason, I don't know why, but let's generally it's someone wants to have personal use of the property and they know they can't use it when it's in their IRA. Yes, you can take a distribution of the property, Sean. We're going to deed the property out of your IRA's name into your personal name, and now you personally own the property. Now, to do that, you have to get a fair market value of the property, which means an appraisal. So for real estate, you're going to go get an appraisal. It's going to set the value. If it is $250K, like you say, then there's going to be a distribution to you at $250,000 of value. It's just like you took $250,000 of cash out of your IRA. You're going to get a 1099-R from your IRA custodian. If you're directed, we're going to send you one of those. We have to. Then you pay tax on it. Now, the good news is, okay, now I could use it personally. Maybe this is a second home or something I'm moving into in retirement. The bad news is you got a $250,000 tax bill, Sean. You got to pay tax on $250,000. Because of that, some clients like to break this up over a couple years or even more. So one thing you could do is transfer half of it out now, deed half of the property, break it into a tenants in common deed, 50% interest, or if you're in an LLC, it's even easier. We just do 50% of the LLC. We'll book that in for a 2022 distribution. And then on January 1st, 2023, you do the other 50%. And sometimes clients just wait till December and do this right in December half and the other half in January of 2023. That way you've broken up that $250,000 tax bill into $125,000 in each tax year. And of course, you could stretch it out in multiple years as well. But that's a couple ideas there. Yes, you can do it. You want to plan for the taxes because there will be a hit on that. I'm presuming this is traditional funds, of course. And make sure you're coordinating with your custodian. It's called an in-kind distribution.
Wow. Mr. Sorensen, that was amazing. You rock.
I did a tough one out of the gate. I figured, let's just get at it.
Okay, this is a good one. This is from I've lost my glasses, by the way. I'm just going to throw that out. So I'm squinting a little bit, and I'm going to pull up my laptop here closer to my face because whatever. Anyway, young or old, some of you wear glasses, and I have two pair, and I've lost both. So I'm just holding it together this week. Okay. Until one of them turns up. Okay, now, so this is from Colin Krieger, Colin, and it looks like he might be out in Mississippi. He says,
Colin, he's a great client. Awesome guy.
Oh, you know Colin? Okay.
You know him. He brought us the king cake in, from at the Crypto Tech Summit.
I remember that. Oh, okay. Yeah, Colin, you rock. Okay, so he's got a good question, everybody. He's dealing with a solo 401k. He says that he owns a rental. Sorry, let's back up. He has a solo 401k that opened an LLC. He put money from the 401k into the LLC, and bought a rental that has great cash flow. Congratulations. You're a great example to us, Colin. You keep up the good work. Now, what I'm adding a little bit to his question here, so it makes a little more sense for everybody. This thing has great cash flow, and it sounds like his LLC is stockpiling cash at this point, because he says, I was thinking I should make another LLC to transfer funds to reduce the exposure of that cash in an incident inside the LLC if the property had a problem. And I was thinking of a brokerage account in that LLC. Would a direct transfer between the two LLCs, both owned by the 401k, that was a good point he made, because if you wanted to open another LLC by the 401k, you could. Would a direct transfer between the two LLCs, both owned by the solo 401k, be okay? Or should I push the money down to the 401k over to the new LLC? And he didn't say it that way, but that's what he's asking. Those are the two options, just an LLC to move the money to another LLC, or put the money back in the 401k, open the new LLC, and put the money into that new LLC from the 401k. He says, just wanted to make sure the corporate veil would be intact. He goes, I keep good books, minutes, records on each LLC, assuming I would do that. Okay, your biggest issue, Colin, is not the corporate veil. You could do either one, to an LLC, or down to the 401k, over and up to the LLC. And it's not going to cause a problem with your corporate veil or asset protection. And good job, keep good books, minutes, no matter what you do. The problem is the direct transfer from an LLC to an LLC. And I'm going to say it this way, Matt, and you give me thumbs up, you know where I'm going. I don't think I want the direct to LLC transfer, right? I want to take...
Absolutely not. Yeah.
Absolutely not. So what I want to do is, anybody where your LLC owned by an IRA or a 401k, it's getting a little cash heavy, and you want to deploy that money somewhere else, you have a couple options. You can just deploy the money right there in that LLC. Go open a brokerage account in the same LLC that owns a rental. But Colin's like, no. I don't want both those eggs in one basket. I want to protect that cash if something went wrong with the rental. Well, then what you have to do is send a distribution down to the 401k. Kind of like your 401k got a dividend from Apple or got a dividend from whatever, which is cool. So you can just transfer money back down to the 401k, call up the law firm as usual, call in and say, hey, I need a new LLC owned by my 401k, but this LLC is going to open a brokerage account or a crypto account or a whatever.
Another property.
Oh, buy another property, yeah. Go buy cows, go buy a mining rig, go buy a restaurant, whatever. So put the money down to the 401k, let the 401k open a new LLC, and then deploy that cash somewhere else. Very common. That's the way to do it. Good boom, bada bang.
Boom, bada bang.
Boom, bada bang.
Was that your signal to me? Then I'm done.
That
Boom, bada bang.
Yeah.
You're up.
Yep, you're up.
Okay. All right. Sharon from Kansas asks, I'm 68 years old. I have a small regular IRA. I presume that means it's like at a broker dealer. I'm still working. I'm getting ready to sell a home I've lived in and rented to some short-term renters. I plan to rent 1 to 2 rooms in my next home. Would I benefit from putting this next home in a self-directed IRA? Okay, great question, Sharon. Your self-directed IRA, whether it's IRA, 401k, whatever account you have, can own real estate, but it has to be held for investment purposes solely. So Sharon, what you've done right now in living in a home and renting out rooms, that ain't going to work with an IRA. You cannot reside at the property. Even if you're renting it out to some other people, any personal use of assets your IRA owns causes what's called a prohibited transaction. If you go back to in the first 10 episodes of the Direct IRA podcast, we go over prohibited transactions and the rules for self-directed IRAs. That's going to violate one of the biggest ones, cause distribution of your account. So don't be using the property or staying in the property that your IRA owns. Now, if you get a place where you live yourself and a separate property, of course, that you rent out and hold as an investment, your IRA could absolutely do that. And that's something we could help with. You just roll over your regular IRA from, let's say, your broker-dealer IRA account over to your self-directed IRA, directed IRA, and then we can get you off going, helping you buy the real estate for whatever property you want to buy that you'll hold for investment only. And we got other episodes on buying real estate with an IRA. You may want to use an IRA LLC in your instance. So check out those podcast episodes as well. But possible, just not exactly how you want to do it, Sharon.
Okay. Did you answer Varit's question from Arizona?
Nope.
Okay.
I did Cheryl from, nope.
Okay, I'm going to open this one. Also, I want to throw this out for some of you that may have posted questions, again, at directedira.com/podcast, and then you can submit a question hit the button to submit a question. Garrett Todd asked a question about capital gains tax, and it doesn't have anything to do with the IRAs. It's actually about the sale of home exemption, yada, yada. I'm going to ask Joanna, one of our assistants here and the marketing team, to make a note to remind Garrett and any of you out there, if you ask a question that has nothing to do with IRAs, please go over to our Main Street Business podcast. That's our sister podcast for general business, tax, legal, estate planning, everything under the sun. Wonderful. It's got hundreds of more episodes and hundreds of more 5-star ratings, and it's great. Just get over there and submit your question at mainstreetbusiness.com. And we do a Q&A open forum there. So that's going to help answer a number of questions right there. Okay, now Yvette or Varit from Arizona asks a pretty challenging question here. I'm going to do my best. Okay, if an older member of a multi-member checkbook IRA start distribution, what happens to the rest of this member's ownership? If this member also will die or withdraw later from the LLC, ? How do you calculate the remainder of ownership interest? Okay, I'm going to try to answer this in general for everybody, and then I think I'm going to recommend a consult with one of our tax lawyers, and in about a 30-minute consult, they can help guide you on what to do here, because it's going to depend on a lot of issues that are beyond the scope of this podcast. And everybody out there, if you want to just make an appointment with one of our tax lawyers and go, hey, I got some specifics, you can do that by calling 435-586-9366, 435-586-9366. We've got 12 tax lawyers, several CPAs in the mix, LLMs. They're fantastic. And just say, I need a half hour. I've got some self-directed IRA questions. Okay. A multi-member checkbook IRA. Let's clear this up for everybody. Checkbook IRA is a term of art that some bozo created to try to sell their bullshit on a website 10 years ago. There's no such thing as a checkbook IRA. They use that term to sound sexy and say you can set up an LLC owned by your IRA and you get to be the manager of the LLC and control the checkbook. That's all it means. So first, everybody, when you set up an LLC owned by your IRA or your 401k, you get to control the checkbook. That's what that's about. So let's keep that term of art in a box. Okay. And then she says here, or he, right, sorry. He refers to it as an older member of a multi-member checkbook IRA LLC. Yep. So what that means, everybody, is that this LLC was created with multiple IRAs. Oh, and there could be regular people in there too. So say Matt and I form an LLC and I put in my IRA, he puts in his 401k, and his mom puts in some cash. We have a 33. We all put in equal money. You can do that. We set those up all the time. And it's not prohibited to do that. There are prohibited transactions. Go listen to the podcast, but that's not one of them. Now, what happens here is it starts to get really tricky. Variety is saying, what happens if there's a distribution, or it sounds like they're trying to buy out some of the members' ownership, and then maybe a member dies or something like this?
Well, let me give a common scenario that happens. I think might be his question is, let's say husband and wife do a multi-member IRA LLC. Husband hits 72, traditional IRA, and has to start taking RMD. They don't have any money in their IRA. It's all in the LLC. But wife's account, she's 65, and she doesn't want to take money out. They want to leave it invested. Well, husband's got to take money. So what do we do? That is the problem.
Yeah. And well, and so that's one possibility that could be going on here. And whenever one partner, let's get back to me, Matt, and his mom being partners. If Matt's mom needs to take a distribution and we're all equal owners, then we all have to take the same distribution amount in that example. If their ownership percentages are different, then we have to do some calculations. But the point is, if one partner takes a distribution, all the partners have to take a distribution. It doesn't
when we say Yeah, when you say distribution too, we're talking about money from the LLC back to the IRAs.
Yes.
So that money could hit my IRA account. Let's say it's 10 grand. I take 3,333. That hits my IRA account. I could just leave it in my IRA, or I could go invest it in something else, transfer it to another IRA. Mom, if she's like, well, I'm 72, I got to take a distribution, that 3,333 hits her account. She's going to go use that to take her distribution. So, so the distribution happens at the LLC level down to the IRAs, and then everybody's got to decide what to do with their IRAs. But the problem with the multi-member IRA LLC is if one partner takes money out, the others have to also, specifically if they're disqualified.
Yeah.
So if it's, mom and son, husband, wife, your traditional, your Roth, one of those, you need to take money from the LLC. The other one's got to take money from the LLC based on the ownership percentages.
Yeah. And there's multiple possibilities that could be going on in this question. We'll leave it at this, is maybe there is some ownership percentage changes going on. Someone dies, someone wants out, someone wants to get bought out, whatever. Someone gets divorced, they have to split up their IRA and the assets within the IRA. So when those things occur, you go to the operating agreement. This is why you just don't, IRA companies and our trust company, we won't take an LLC from LegalZoom or anywhere. You've got to have it carefully crafted with proper verbiage so that you don't get into problems with the IRS. So if you haven't got the right operating agreement to deal with this kind of stuff, the attorney you call at our office will help get a new one drafted, get everybody on board, and we'll find out what's really going on here and make sure any distributions are handled properly. So this is good stuff, everybody. This is exactly what you need to be doing, is asking these types of questions, because you don't want to screw it up. So love the question.
All right. George from Indiana asks, my solo K is a 50% owner of an LLC that owns a building and leases it to a third-party tenant that operates a gym. Can I work out in the gym as a member of the public, paying the same rates as everyone else? Yes, you can, George. All right. And I want you to throw some weight around in there, really, get fired up. But yes, you can do it. Let's walk through the issues though. If your 401k owns 50% of an LLC, that LLC leases to another company that's a third-party tenant. It's not your tenant. You've given rights to that property now to the tenant. That tenant has a business you want to become a customer of. That is okay. Okay, this is one step removed here in the scenario where it is a legit, true third-party intermediary company in the middle that's the tenant. Now, why this is okay is because George is like, hey, I'm paying the same rates as everyone else. Now, let me tell you what would not be okay. If the tenant was like, hey, since you're also kind of my landlord over here with your 401k, I'm going to let you personally work out over here in the gym and you don't have to pay a fee. Okay, that would be prohibited. But if George, you're just paying and doing what everybody else is, you want to work out at that gym regardless, you're not paying more or less, I don't see a problem with it. The only issue, of course, would be self-dealing. But like I said, you're paying the same rate as the general public. And therefore, there'd be no self-dealing in that scenario. So great question. There is some guidance, by the way, from the DOL on issues like this that say if there was something prearranged, though, where you got some special treatment because your 401k back here one step removed, lease the property to this tenant, there could be an issue. But sounds like you're just paying the same rates as the general public. I don't see an issue with it. Okay.
Great question here from Joanne out of California. Says, if you have a solo 401k, now this is kind of not a self-directing question directly, no pun in words there, but she's asking about the solo 401k, which you can self-direct and is a big deal. So I want to answer this here. So Joanne says, if you have a solo 401k through your S Corp, so any of you out there that have a small business, it's just you and your spouse or you and a kid, maybe even you and a partner, that would be a little more odd, frankly. You're going to probably have employees. But for any of you out there that just kind of a solopreneur and you've got an S Corp or an LLC structure and you're out making money, the solo 401k is phenomenal. It allows you to really double, triple down on what you're trying to do in a Roth IRA, because you can have a Roth or a traditional or combination solo 401k. The fees are so reasonable to set up and manage. You can self-direct the hell out of it. Great. So I want to give Joanne some kudos here and a shout out for doing some good things here. We need to all save more. We all need to invest more in what we know. That's the beauty of self-directing. Mm-hmm. So her question then says, I already have this solo 401k. Can I also set up another 401k for an LLC which holds rental property? On the face of it, the answer is no, but there's so many options here. The first thing I'm going to say to all of you is, I don't want Joanne to have a second 401k. I'd like to try to get around that. Believe it or not, here, your law firm's not trying to sell you a 401k. You guys are like, hey, these guys sell us everything. They're expensive. No, we're not. And we want you coming back. So let's think about this. Let's say Joanne let's say she's a dentist, or she's a realtor, or she's doing some social influencing or whatever, but she has an S corp and she's set up a solo 401k. That's cool. Then over here, she's got an LLC with some rental property. And like Colin earlier, maybe that thing's cash flowing like crazy. And she's like, I want to take the money from my rental property cash flow and put it in a 401k. But I'm not an employee of that LLC. I can't do that. And the LLC is only for employees, which you cannot do with a passive operation unless you put yourself on payroll, which you can't do in an LLC. So she's stuck, she thinks. But what I like to do is call this the side door 401k. Pay a management fee from your LLC that owns the rental over to your S corp. Just say, I hereby hire my S corp that also does social influencing or dental work or realtor work. I'm going to hire that S corp to manage my rental. Not me. I'm going to hire my S corp. Now, you would never, ever do that and create ordinary income on the S corp side. Just take a draw if you want it. You don't have to do that. But she wants to fund her 401k sponsored by the S corp. So to get the money over to the S corp, we got to pay a management fee. Then she can turn around and boom, drop that right into the 401k. Easy schmeezy. Another technical term. I know I'm throwing down a lot of technical terms today.
Yeah.
It's hard, people. Take notes. But that's be the easiest way to go. And I can't imagine her saying here that you have another partner in the mix, or she would have proposed that somewhere in this. It sounds like it's her S corp and it's her LLC. So this would be the perfect thing to do. And again, make a call to one of our tax lawyers for an hour, maybe book an hour and say, hey, walk me through this. Here's what's going on. Build a trifecta. We have this trifecta built service for around $1,200. We look at your tax returns and give you a plan for the year, build a trifecta, or we can set up a new entity and give you a trifecta. Or we can even clean up one of your old entities and do a trifecta. So we have these 2 or 3 services that really help you get a plan for the year. And then you just circle back once a year. Just like you're, again, use a dental example. Maybe I got dental. I made an appointment to get my teeth cleaned in the morning, Matt. Maybe that's what's going on with the dentist.
That's it. It's on your mind.
It's on my mind. I'm already nervous about my hygienist.
Hey, 9 out of 10 dentists appreciate all the dental examples you gave in today's podcast.
They do. That's
9 out of 10.
9 out of 10.
They also recommend Colgate. And they also happen to 9 out of 10 also recommend Crest. And 9 out of 10 also recommend Brand X. I don't know.
They all
like, really?
9 out of 10 recommend everything. Yeah, I've seen that. Who are these 10 dentists recommending everything? Yeah, but I just want
to know who the one is that's like, nope, I'm not in on this one, guys.
I'm not recommending anything. I'm out.
That's the cool dentist. I want to go to that dentist.
Yeah. Like, he's a cowboy. She's a cowboy. Yeah, I like it.
Love it. Okay.
Oh my gosh.
Cheryl's got a question on kind of on the same 401k vein. So I think I can answer this one fast.
Okay.
And if you're not ready, Mark,
I'm going to get ready.
I'm going to do a fast one. Okay. All right.
Did you do Gulfridge? You didn't do Gulfridge, did you, in Florida?
Nope.
Okay, I'll go to Gulfridge here.
Okay. All right. Cheryl asks, could you make a contribution to your solo 401k from multiple streams of income as long as you're paying self-employment tax from your income and are in compliance with the rules for solo 401ks? This is very similar to what Mark was answering on the prior question, but let me give an example of where this happens and what you got to make sure you're doing right. If you have the S corporation, like we were talking about, very common for those that do a solo 401k. If you have an S corporation, you might have multiple streams of income, different businesses, all the things Mark was just talking about there. Now, if you have a separate business, maybe it's a sole proprietorship, or it's which I don't know why you would do that, but let's just say you did. We need to have these separate companies become affiliated employers. Okay, they need to be part of this group of employers under the plan that's for you that could then make contributions to the solo 401k. Now, if it's like, hey, this is just my S Corp that created the solo 401k and I got 10 different types of income I run into my S Corporation, cool, knock yourself out. That can all be contributed to the solo 401k. If it's a separate business entity, though, separate tax ID, yes, it's possible, but it technically needs to be an affiliated employer under the plan, which they can be added. Sometimes it's called an additional employer under the plan. It can be a plan amendment if you need to do that in order to allow it to contribute money in. So that's all you got to do, Cheryl. Don't overthink it. The employer that adopted the plan, no matter different types of income, you can contribute. And of course, if you got separate entities, just make sure they're an additional employer under the plan. That way they qualify to contribute too.
Okay. I want to clarify, Gulfridge is not a person. That's probably the name of the LLC here. It's Elizabeth. She says,
oh,
so I think
Gulfridge would have been a cool name, Elizabeth, though. I mean, yeah. Elizabeth's good too. But.
Yeah. Gulfridge, more of a kind of a guy name, you know. Gulfridge. Yeah. It's kind of a
I don't know,
yuppie
like
name.
A Viking show or something. No, Gulfridge.
Gulfridge. I don't know. He's on the rowing squad. I could see him.
Yeah.
Gulfridge. Yeah. Maybe. Okay. So Elizabeth says, out of Florida, is it legal / possible? Now, those are two different things, Elizabeth. Let's be clear. I don't know where you're going, but we may have to take this question offline.
Yeah, it's possible to smoke crack, but is it legal? That's a different question.
Yeah. Okay.
It's possible to drive 100 miles an hour.
Yeah. This is funny. Is it legal possible to take a loan against our own unleveraged property as a means of asset protection? Now, I'm going to twist this into a IRA question because I started the question and I'm dealing with it. But
you stepped in it.
I stepped into it. I got to step out of it. Okay. So but this is a common question we get on the IRA front as well. And so let's look at both. Mm-hmm. So is it legal to take a loan against our own unleveraged property as a means of asset protection? I think Elizabeth's talking about is what we call equity stripping. And anytime I can use the word stripping in a podcast, I'm going to do it. So James, sorry, stripping. Okay. All right. Thank you. Oh, look at that's our first little, okay, cool. We need something more provocative than clapping.
We can download some things for you guys.
Okay, yeah, something like, okay. All right. So here's the thing. If any of you out there own a property free and clear, which another way of what Elizabeth is saying, and you want to take a loan against it, with what she's saying is set up an entity and lien your own property so that the world thinks there's a loan against your property. That's what's called equity stripping. It's a technique to create smoke and mirrors that there's a loan out there on this property, and someone that's in a lawsuit against you may get sidetracked or not dig deep enough in discovery and just leave that property alone because I think it's leveraged. Now, a good lawyer in a lawsuit would find out quickly that it's just a sham. But again, it's a superficial way of creating some asset protection for fun, and dissuading people in a potential asset search or lawsuit. But is it substantive, and would it hold up as a true asset protection technique? Probably not, unless you went out and got a real HELOC with a real bank and liened your property and then use that money somewhere else. Yeah, you stripped out the equity, and if someone sued you and tried to go after that property, they'd have to pay off the loan first. So you've really protected a lot of that equity. Now, if we twist that and go, can you do either one of those strategies with a property you own in your IRA? Generally, no, because a HELOC is going to ask for a personal guarantee, which you cannot provide on a loan against an IRA-owned property. And also, you're not going to want to take one of your own entities and lien a property owned by your IRA. That simple act would be a prohibited transaction. So I would say to all of you out here, here's the big takeaway. If you have a property owned by your IRA, it's already asset protected from your personal actions. Someone cannot sue you and generally get into your 401k or IRA. What you want to do is, like Colin at the beginning of this show says, I got some equity in this LLC property scenario. Maybe I want to protect it from other eggs in the basket. But trying to create asset protection for a property owned by your IRA generally defeats the purpose of retirement plans as they were set up by Congress in the first place. So I hope that helps. Listen to one of our podcasts on using leverage with your IRA. We have several podcasts on that. You'd love it. Okay, Matt.
All right.
Boom it a bang.
You guys know,
Sorry, boom it a bang.
Boom to bang. Okay, all right. That was my cue. All right. I'm alive. Mark bills by the hour, obviously, and has for 20 years. So, sometimes he goes long. Okay. God. Karen from California asked, she's got a two-part question here. Karen, I love it. You're going for two. And they're both good questions. Says, does one need a separate self-directed IRA for different types of assets? For example, crypto, stock, or real estate. Now, crypto is the curveball there, Karen, because with crypto, we do have a crypto IRA product where you just do crypto. You have an IRA at Directed IRA. It is going to own a Gemini trading account, which is going to be on exchange at Gemini. You can trade on it 365, 7 days a week, whenever you want. You're trading on that thing. And you have access as a trader. But your IRA owns it directly. Now, in that instance, that's the only asset you can have because it's linked through Gemini with crypto. It's a little complicated, but we try to simplify it for those clients that just want an easy, clean way to do crypto. Now, for real estate or stock or other assets, you can just do that out of one self-directed IRA. Now, a solution where you could do all of these things if you wanted would just be doing an IRA LLC, Karen, where we have an IRA, a self-directed IRA, own an LLC. That LLC could get a wallet to do crypto. It could buy real estate directly. It could have a brokerage account with to do stocks in the LLC's name if you wanted. So you could do all those different types of assets in the IRA LLC. That might be something to look at. Now, Karen's second question was, if I'm funding via a backdoor Roth IRA, is it an annual transfer from the traditional Roth, from traditional to Roth to self-directed Roth IRA? This is a great question. In the old days, you would have to do that. But at Directed IRA, we've turned that 3-step process into 2. And really, it's 1-step process for you. We just have to break it down into 2 to make it legal. Or should I say possible? But, okay, on the backdoor Roth, what you're doing, remember on a backdoor Roth, you're contributing to a traditional account because you don't qualify to contribute directly to a Roth, but you're contributing to a traditional, which you don't get a deduction for because you're high income. And you're converting it over to Roth. So those 2 things have to happen: contribution to traditional, conversion to Roth. Now, you don't have to go traditional to Roth to self-directed Roth. At Directed, we have a backdoor Roth IRA account type, and you basically set it up, and then we set up a traditional account where we book your contribution, and then we convert it over into your Roth account. And you can do that every year. No reason to do 3 steps there with another Roth to self-directed Roth. Just come over here. We'll get it right in your self-directed Roth. We do have to drop it in your traditional Roth to comply with the rules, but we've simplified that into a 1 step for you, which we implement into 2 steps to make it legit. There you go, Karen.
I'm waiting for my...
Bada bing, bada boom.
Okay, so there we go. I was waiting for my cue.
That's not going to be mine, though. I got to think of what's my out going to be,
Showing.
Showing.
Little Wayne's World. Did you do that? There you go. Yeah, there we go. I don't know. That's a little more princess. Princess Wand. I don't approve of that.
I don't approve of this message.
Yeah.
And actually, that's going to be mine. I'm Mat Sorensen, and I approve of this message.
Oh my!
That's going to be mine.
I don't need more political BS right now. Okay, all right. Okay, so question. Here's a good. This seems to be kind of the theme today is solo 401ks. This is from Chris in North Carolina. Says, hey, Mark and Matt, love the show, especially everything Mark does for the show. It really adds a ton of value. Oh, sorry. Maybe I was reading between the lines there. Okay. It says, I've learned so much from you too. Okay. Here's my situation in question. I have a 1099 consulting gig that pays around $50K a year. Love it. And I have a regular W-2 job that's above the FICA threshold. So if people, you don't know that, what that means, that's around 140 grand. So Chris is killing it. He's got a big W-2 over 140K a year. And he's doing some consulting on the side, 50K a year. Very, very common. We love that model. We want to encourage that all day long. People, you are an expert at something. Learn how to make money at it. Learn how to make money at your hobby. Take that extra side gig and let's use it to build long-term wealth. And that's what Chris wants to do here. He says, I want to put away as much of the money from the consulting gig as I can into a retirement account. With the strategy of using an S Corp to open a solo 401k account and run the consulting gig big business for me, give me the most bang for my buck. What strategy would you recommend? Blah, blah, blah. Okay. Several strategies I want to highlight here. First, Chris, you're absolutely correct. This goes with Joanne and some of the other questions today. Let's make sure that you have an S Corp set up with a solo 401k sponsored by the S Corp. You're pumping that side gig money into it, and you're driving it right over to that solo 401k. The team can help you figure out the right numbers and dollar amounts and ways to maximize that contribution, giving you the least amount of FICA cost. That's the trick. Now, number two, I love the strategy I've coined called the matching out strategy. Matching out. I think I have a blog article already out on this. I know it's maybe in draft mode still on my WordPress account, but I've been working on an article called the matching out. And what the matching out strategy says, go play at your day job. If you've got a $140,000 W-2 day job, I bet you there's a 401k sitting over there, people. So Chris needs to go over there and play in that account up until the match. So let's say they're doing a 3% match up to X dollars or dollars up to this amount, whatever it is. If they're going to match up to 10 grand, go over there, Chris, put in 10 grand because they're going to match it. You just doubled your money. No matter whatever crappy investment they have in that 401k, even if it's 2% a year or whatever the hell it is, you just got 100% return on that match. So do the match and then get out. Go over to your solo 401k. And with that gig money, do the rest of your 401k and more. And don't forget your own little solo, I should say, your own little personal Roth IRA. You can have all three, people. You can have a personal Roth, a day job matching out, and a side gig 401k, and maximize all three in concert. And that, my friends, is where, oh my gosh, set up a damn call with one of our tax lawyers. Call today. Get over there. I don't care if I'm being salesy here. This saves you thousands and thousands of dollars and makes you thousands of dollars. You'll spend around $400 for an hour. They can apply it towards future services on other things, or a fixed service that you might need. Call, get that sweet spot figured out, and it's huge. And Chris, you can do the trifecta, get an entity set up. We'll throw in a 401k. Typically, we'll knock $100 off or so there because we're doing a bundle of services. Get with an attorney, and they'll help put together a sweet plan for you.
All right. Love it. Greg is up next. Greg from Ohio. All right. Greg from Ohio brings up a really important question that could cause a lot of havoc for those of you with inherited IRA accounts. Okay. He asked, he read an article saying that the IRS is changing the guidelines for inherited IRAs. He says some people will take a big tax hit now rather than deal with 10 years of calculations. All right, so let me tell you everyone what's going on with inherited IRAs. If you inherited an IRA from someone, family member passes away, let's say your rich aunt, or this is not your spouse, maybe it's your parents. Okay, you end up inheriting an IRA from someone. Under current rules right now, you have 10 years to distribute that account. Okay, you can use it and keep investing it. You got 10 years as an inherited IRA to use it. Now, what happened is the laws on this changed about 2 years ago, and everyone's like, great, we love this new law. We got this 10-year window, and I can just use the account and keep investing it as long as I distribute the full thing by the end of 10 years. Then the IRS started tinkering with this, and they looked at it and they said, well, but does this really apply to everyone? What if when that person died, let's say your mom or dad that passed away and you inherited their IRA account, what if they were already in RMD? Let's say they were 80 years old. This is a traditional account. They were already in required minimum distribution age. When you inherit that, do you have to start taking distributions, or do you really get to wait 10 years? Now, everyone else thought, nah, we get to wait 10 years. And we love that, right? Because we can invest it. We don't need to worry about taking money out. If you're self-directing, just keep doing the thing. You got 10 more years of tax deferral and benefits. But the IRS came in and ruined the party. They said, actually, if the prior deceased owner was in RMD, you have to start taking annual distributions too over that 10-year window, which is a pain in the butt. So this is current guidance from the IRS. This is preliminary guidance. The whole industry is challenging this. Greg's referencing a Wall Street Journal article that was just talking about it recently. So be aware, any of you that have an inherited IRA, the IRS is tinkering here. Pay attention to the rules. We'll, of course, be following it here on the podcast and have a newsletter article on it once we get some clarity on it. But just a heads up for those of you with an inherited IRA. And a great question, Greg.
All right. I need a cue. Sorry.
Oh, I'm Mat Sorensen, and I approve this message. I'll think of another one. Let me just say that last answer is not to be used without the express written consent of Mat Sorensen, Inc.
Okay, there we go. All right. Okay.
Or maybe I'll do like a shake and bake.
Ooh, shake and bake, dude.
Shake and bake.
Oh, I love
it.
Bake. I love shake and bake. Okay. It's also really
good on chicken. But I'm Ricky Bobby in that example, by the way. I'm Ricky Bobby.
No.
You're the other guy.
No.
John C. Reilly. The Magic Man. What was he? I'm the Magic Man.
You're in first place. I'm the loser. You're in first place. Okay. All right. Okay. All right. Here's a question I need to give another little side note here. Dr. Greg Watson asks about Medicare asset protection thoughts. And again, it's outside the scope of IRAs, but it is a very important question. Please get over to mainstreetbusiness.com, pose that question, and clean it up a little. Everybody, what Greg's talking about is a Medicaid asset protection trust from states that want to go back and reclaim assets after someone takes Medicaid, or someone that's trying to get Medicaid but has assets and they need to spend down. I'm going to tell you all my personal opinion on this, because this is I believe in this, and I got to say it. I'm sorry you have to listen. If you listen to my podcast, you're going to hear my opinions once in a while. If you have money, pay for your own damn long-term care. That's what the Medicaid spend down provision is about. Anybody that calls me up and says, how do I hide my assets so I can get Medicaid? I have two thoughts. First, you cheapskate. I don't want to be paying into some state-ran system, which we all do in some form or fashion through government funding. I don't want to pay for your or your grandma's or your mom's or dad's long-term care when you got money to do it. Quit trying to skirt this damn system. Own it. Go buy some long-term care insurance. Get prepared. And by the way, you got to go tour some of the facilities that allow for Medicaid funding and take care of your health care. You don't want to be there anyway, and certainly not anybody you love. So you thinking you're saving money to go get some Medicaid-supported long-term care facility or help? It's not worth it. Trust me. And I'm going to say this on a personal note. My father died of Parkinson's, and we went through that experience. And my mom right now has Alzheimer's. And so I'm living it too. But we tried to plan as a family to take care of him with the highest possible care. And trust me, it's not Medicaid. So be careful going down that rabbit hole, everybody. Lena, easy question here, asks from Nevada. Can an LLC pay my IRA LLC for services, or I think she's actually asking the opposite. Can my Roth IRA LLC pay my S Corp for services I personally provide? Either way, you're screwed. Sorry. So you can't do it either way. So everybody,
that's a no-go zone.
That's a no-go zone.
Lena.
Yeah. Little Top Gun reference. That's a no-go. That's in the zone
Yes.
of don't. Yeah. So
Below the flight deck, no flight zone.
Yep. No flight zone.
The hard deck.
Hard deck. There we go. Oh my gosh, Tom Cruise, so freaking amazing. If you haven't seen Top Gun, okay, okay. If you haven't seen Top Gun because you don't like Tom Cruise or you don't like Top Gun, the first show or whatever, people, you need to see it alone for the fact there is no digital work on that project. It was all real footage. That's phenomenal. When you watch it and you're like, you got to be kidding me. And that's Tom Cruise really flying the jet. No CGI.
Yeah. That is
Thanks for
cool.
clarifying my attempt.
And one of my favorite parts of the movie was Tom Cruise at the very beginning welcome everyone to the movie and why they shot it. I love that. This is so good. He gives a
actors should
little
do more of
interview right before the movie, and it's like it was just a little awkward at first, but then it hits, and it's pretty good.
Just amazing. And so just when you see pure talent, like maybe you're not a certain singer fan or a certain pianist fan or a musician or an athlete or an actor, when you see pure talent like that, he's flying his own jets. I don't care. You got to appreciate that. So it's a really good movie.
You got to give it some respect.
You got to give it some RESPECT.
Tell me what it means to me.
Boom. Okay, so here's the rule, everybody. Your entity cannot pay your Roth IRA LLC for anything, and your Roth IRA LLC or any type of 401k IRA LLC cannot pay you for doing something. I wish you thought you could, but you can't, and that would be prohibited. Go listen to the Prohibited Transaction podcast. Just for the reason you asked this question, Lena, I know you have not listened to that podcast episode on prohibited transactions, and you need to, because there's about 10 other things you can do and 10 other things you can't do, and you need to know the rules. Boom, bada bang. There you go.
Boom. Love it. All right. Okay. All right. Kay from California asks, safe agreements in a self-directed IRA. Can safe agreements be held in a self-directed IRA or trust? She says, safe agreements become shares in the future. And she also says, thanks for the humor and advice. Well, thanks, Kay. Sometimes we get comments of people that are like, can you guys stop with the jokes? Just get to the point. You know, Kay appreciates the humor. Guys, Kay appreciates
you get those comments? I never get those comments. They're like, all we want is humor. Quit answering dumb questions. But that's
I delete those comments so you don't see them. I just
okay. All right.
You know, no, but Kay, great question. Safe agreements. These are becoming pretty popular. I'm seeing a lot of them actually at directed IRA. Safe agreements are getting startups, Silicon Valley world. They love these safe agreements. It's basically an investment that's a debt instrument that can convert to shares if the company ends up taking off. It's a simplified way to do it. It's become very standardized in Silicon Valley. There's been a lot of success stories of big companies that made it big and people made a lot of money investing in quote unquote safe agreements. It's kind of like a convertible note in a way, if you're familiar with that, where you have debt that converts to shares. So yes, we've had lots of accounts invest in those, Kay. Of course, you got to pick the good ones, just like any other asset class, real estate, stocks, private equity, safe agreements. There's winners and losers. You just got to pick the good ones, Kay. So but absolutely, your self-directed IRA could invest and hold that. We're doing it every day here at Directed IRA.
Okay.
Sorensen out. Just kind of like Seacrest.
You just said
out.
you were doing shake and bake. You just said you were doing.
Kind of, you know, I'm still finding my groove.
You're as indecisive as.
No, I'm workshopping it. You know, like any good comedian, I'm just workshopping it. You know,
I'm hearing crickets. Okay, all right.
We didn't like Sorensen out. I mean, that was a throwback to Seacrest.
I like shake and bake because shake and bake's kind of like, I'm done, go rock it. Shake and bake. I kind of like that, but it's up to you. You're workshopping
but bada bing, bada boom is kind of like.
It's Italian. I just watched The Godfather the other day. I was kind of in an Italian mood.
Oh, bada bing, bada boom. You gotta really
bada bing, bada boom. I gotta throw in an accent. All right.
Okay. That would help me.
That would help. Well, that's what this is all about, is helping Mat Sorensen. Okay. All right.
Well, you're passing me the baton with the bada bing, bada boom.
Okay, true. Fair enough. Got to give you some energy.
Sell it this next time, all right?
Okay, next time. This is the last question, and then I'll give you the proper bada bing, bada boom. Okay?
Okay.
The last question for me. Sharon Burke. Where's she out of? I thought it's Kansas, I think. Yeah, Kansas. I'm 68 years old, and I have a small, regular IRA.
I did this one already.
Oh, you did Sharon's?
This was the first one.
Oh, way back then. Okay.
This is the first one I did. You want me to answer another one, and you'll go.
Then I'll go last. Yep. If you've got one ready, go ahead. Okay.
Okay. All right. This was Andy from Florida asking about numismatic coins. Numismatic coins. That means collectibles. IRAs and 401ks can own actual precious metals. So your IRA can own gold. It can own gold bars, gold coins. It can own silver, platinum, and palladium. Those are the 4 types of precious metals IRAs can actually own. Now, you can't physically store them or have them in your possession. There's been some recent cases on that. We've always been like, definitely can't do that. Someone finally got caught doing it, some moron. So you can't do that, but you can certainly own precious metals. They just got to be stored properly with a custodian. Now, numismatic coins means collectible, and collectibles are restricted by the IRS, but the IRS, I should say that in the tax code, collectibles are restricted, but there's some loopholes to collectibles on what is allowed. And those loopholes are gold, silver, platinum, and palladium that meet certain requirements. They're either government-issued coins, like think of the American Silver Eagle, that type of stuff, or they meet fineness and purity requirements. And platinum, palladium, gold, and silver all have different purity requirements. There's a chapter in my book on precious metals that goes over purity requirements. It also goes over the tables of what coins are allowed and what aren't. A lot of coins are not allowed that people want to buy, like Krugerrands. Not allowed. I think those are from Australia. You can't own those in an IRA. Where are they from? South Africa. South Africa. Krugerrands. Can't own those in an IRA. But you can you can own certain coins, like the American Eagle. Could be gold or silver. So, and there are other Canadian coins actually that can be owned. I don't know these ones that you're asking about, the Rose Crown Guineas or the Wildlife Series. I do have a table of all the common coins in my book, Self Directed IRA Handbook, Chapter 9. In fact, maybe I'll pull that out here while Mark's answering the questions.
Okay, I'm going to hit a few quick ones. They may not be answers, but at least giving direction. Nicole Mistidi from Oregon brings up a partnering question with her self-directed IRA. Her and her partner are 50-50 in an IRA LLC, I think. 54 and he's 63. They want to build triplexes. They self-directed IRA company that we have, our self-directed IRA, said that we can take a percentage distribution of the property, then partner with our IRA to build. We could, for example, distribute 80% of the property so that Nicole, you got to get a consult with one of our tax lawyers. There's multiple, she said, do you agree with this guidance? Are there hidden dangers? Yes, yeah, no, yes, this, no. You've got so many options, and I would not take a distribution from the IRA. You can set up an LLC and partner with your IRAs to do a development. There are some prohibited transaction concerns, but it's very doable. We have clients do that on a regular basis. So I guess what I'm trying to tell everybody here is if your IRA owns a lot, and you want to develop that lot, you can form an LLC where the IRA, their contribution to the LLC is the lot, and then you might put in cash or have other retirement accounts. It's doable. You just need to make sure you've got your tax lawyer there along by your side, making sure you do it right. So hopefully that helps, Nicole, there. And someone else asked a question about... well, we'll leave it at that. I'm just going to throw this out. If any of you are like, you haven't answered my question, if it's not directly related to a self-directed IRA scenario, please go repost it at mainstreetbusiness.com. Bada boom, bada bang.
Okay, Tony. All right, I like that. Tony Soprano, maybe?
Yeah, maybe.
I've never seen Sopranos. Maybe I got to get onto that. I don't know if I'll be into that, but anyhow, well, thanks everybody for all these awesome questions. We do this show at least once a month where we take your questions. Get over to directedira.com/podcast. You can hit the ask a question. As Mark said, we like to hit the IRA, 401k, self-directing questions, keep it in that hemisphere. All other tax and business asset protection stuff outside of that, get over to Main Street Business Podcast, or mainstreetbusiness.com. Main Street Business Podcast? Yeah, .com. And we have a question and answer series going over there too. So, and we're doing an open forum episode there as well.
And you can do mainstreetbusiness.com or mainstreetbusinesspodcast.com. They both end up on the same landing page. And we'll be doing an open forum soon. We've been doing a 3-part series on asset protection. It's really in depth, and people have really responded well to that. So check that out. And then we'll get back to an open forum here in a couple weeks. Thanks everybody for listening. We'll see you next week.
Yeah. Till then, stay calm and self-direct on.